Okay, so this is random as shit, but you're probably familiar with stock options,
The options market.
The options market. The options market.
but not the kind Elon gets for no reason. I'm talking about stock option contracts. Stock option contracts are contracts between two parties agreeing to buy and sell at a specific price and date, but each contract represents 100 shares of stock, so they are insanely levered up. Now, there is a lot you can do with options. You can buy a call, sell a call, buy a put, or sell a put. You can sell a call and buy a further expiring one, and that makes a debit spread. If you do the opposite of that, that's a credit spread. You can do a strangle, which is buying a call and buying a put at different strikes, but you can also do a straddle, which is buying a call and a put at the same strike. There's something called an iron condor. I have no idea what that means or how it works, but I do know what it does, and it's pretty interesting. You can basically bet that the price of a security will remain within a certain range. And if it does, you get paid. I find the debit spread very interesting too, but in a more degenerate way. Let's do an example. Let's say Uber is at $75 per share right now, which it is because it's had a big decline recently, but the fundamentals of the business are still perfectly sound, and you believe that the price is bound to go back up in the next months. What you would do if you were an intelligent investor who prioritized risk management and intrinsic value is to simply buy shares and hold them until the price hits your maximum value. Or if you were an even better investor, you could sell put options for a price slightly below current, which means you get paid around 0.5% to 2% in premium, and if the price hits your lower target, then you automatically buy the shares at a higher value per dollar and still wait for them to hit your target price and sell then. But that's not degenerate enough. What you can do with a debit spread is you buy a call in the money and then sell a call out of the money. That creates a debit spread. You pay a premium, and now you have basically created your own roulette table. If the price rises even a little bit, your spread expires in a 100% gain, and if you are wrong even by a little bit, you end in a 100% loss. Basically, you are betting on red or black. But the craziest part is, the odds might actually be in your favor. Because let's look at this way. Uber has dropped 30% from its all-time high. Its price-to-earnings ratio is the lowest it has been since its IPO, and its free cash flow yield is one of the highest since its IPO. All their fundamentals are holding very strong, and you, me, and everybody else will continue to use Uber and Uber Eats. So it is kind of a no-brainer to say that it will eventually move up from its current price, and if that turns out to be the case, then you just doubled your money. So if you play this strategy right, you can actually create a red or black roulette table, but the odds are set by you in the market. But okay, now why am I talking about this? If you're even a slightly sophisticated investor, you are probably familiar with all of this. Well, there is this very specific options strategy which I find so incredibly fascinating and at the same time incredibly useless that I just felt this is what the first video for our investments in financial media company, Furutana, should be. I'm talking about box spreads. A box spread, specifically a credit box spread, means you sell a call spread and sell a put spread at the same strike and expiration. You then receive money now and owe a fixed amount at expiration, like a loan. Let's do an example. Let's say you sell a $75 Uber call for plus $4.35. You buy a $79 call for minus $2.58. You sell a $79 put for plus $7, and you buy a $75 put for minus $5. What happens after is you receive a credit of $377, and you have to repay $400 at expiration. You've just created money out of thin air and borrowed at the risk-free rate, which is around 4%. And there is virtually zero risk because all the options cancel each other out. So it does not matter where the stock moves, your position remains the same. Amazing, right? Borrowing money at the lowest possible rate, straight from the market, with no need for credit checks, interviews, or audits. This is what you would call a synthetic loan. If right now you're thinking, that seems too good to be true, it's because it is. Not because you are not able to do it. You absolutely can, and you will get credited that money to your account. But the problem lies within the fact that the broker will not let you touch that money. They don't let you buy stocks with it. It doesn't count as equity in your account. You can't use it as collateral. You can't even move it, store it, or anything. The only thing they let you do is look at it. That's it. That's all you can do. Borrow money, use it for absolutely nothing, and then return it while paying interest on top. So Why is this a thing? This seems like the most useless and nonsensical investment you can do with your money. I wouldn't even call it an investment. It just seems like a waste of time. It feels like the time I spent researching this, learning about this, and then the time you spent listening to me talk about it served no purpose. Well, okay. It's not completely useless. For big institutions, of course. If you have a $500 million fund with a personal relationship with your prime broker at Goldman Sachs or UBS, they will in fact let you do this strategy and actually use that money for trading. Seems unfair. They get to borrow money whenever they want at the lowest rate and use it for whatever they want. I do have to say, I don't believe it is totally unfair, since these institutions have much better credit than your average Robinhood trader. But that does not mean they can't engage in unheard of levels of degeneracy and completely obliterate their investors' money. But still, the fact is that in financial markets, whether you like it or not, whether you realize it or not, the big guys will always have an advantage. Since we are not able to use these kinds of strategies yet, the team here at Fortina is working very hard day by day on perfecting our abilities to find the best undervalued assets and hold them long term. That's basically all we do. We try our best to find the best undervalued stocks each month and then analyze them deeply to see if they are a worthwhile investment, with the overall goal of outperformance. So it's only a matter of a couple of years, and we will be under the AUM threshold for these prime broker relationships. When that happens, we will not only be talking about these kinds of option strategies, we will be actually using them. Thank you for watching, and click the link in our bio if you want to access our stock research or if you want to invest with us. Nothing seen in this video should be considered financial advice, and please do not do a box spread. You will waste your time.